Why do American banks keep on failing? Who's failing? Is it capitalism? Is it the system? Is it people in the banks? Who the hell keeps on letting us down? I think to understand this, you gotta understand a couple of things. First of all, what happens when you go into a bank and actually make a bank account? Like, what's happening there? When you go into a bank and you make a bank account, let's say you deposit $30,000, what is actually happening is the bank now owes you $30,000, callable at any time. Meaning you could just walk into a bank and say, yo, teller bro, I want my 30 grand ASAP. I want my 30 grand now. Now, they have to give it to you, right? But what do they do with that 30 grand that they've now borrowed from you? So what they do is that they go and invest it. And by invest it, they mean lend it out on things like mortgages, credit cards, and also buying something called treasury securities. Now, what the hell are treasury securities? Now, treasury securities and loans and bank accounts are part of the ways that the treasury and banks work together to print money. What does printing money even mean? Do they create money out of thin air? Kind of, right? Because let's say you've deposited your 30 grand into the bank. You believe you have 30 grand, you can go and pull it at any time, spend it on whatever the hell you want. But then they go and loan that to somebody on their Chase credit card. Now, you have 30 grand and some other guy has 30 grand on his Chase credit card. Who has the money? The answer is both of you. They have now created $60,000 out of $30,000. And they do this multiple times and they keep on stacking it. That's one way that they make money on your bank account. Another way that they make money on your bank account is by buying something called treasury securities. What are treasury securities? So, a treasury security is basically a bond or a debt issued by the US Treasury that they say we're gonna pay a fixed percent a year and trust us, we're the Treasury, we print the money. Trust us. Whenever someone says trust you, or to trust them, I don't know. They go and buy these treasury securities, which are yielding at whatever the current Fed rate is. You may have heard the Fed's upping it, the Fed's lowering it, and more recently the Fed's upping it, and it's upping it a lot. And what does that mean? That means that a year ago, they were selling securities at a 1% interest rate. Today, it's at like 4%. Now, what does that do to the actual price of the security? Because if you buy a bond at 1%, and that now bonds are yielding at 4%, you want to be able to go and make your 4%. You want to get rid of that 1% bond. What can you do with it? You've got to sell it. But who wants to buy that bond? Who wants to buy something which pays 1% when everything else is paying 4%? So what happens is that the price of that bond gets marked down. Bonds are issued at face value of $1,000 or $100. And that price gets marked down that the effective yield, what they would make on that bond, becomes 4%. This lowers the price of all of those bonds or securities. Now, let's say the bank has gone and taken your money and bought treasury securities with it, yielding 1% a year ago. But now those treasury securities are worth a lot less. You may ask, are those things gonna show up on the bank's balance sheet? I should be able to know these things because banks have to file filings. They've got to file with the Fed. They've got to file with the SEC. They've got to file with all of these different people. Someone should be able to tell. And the answer is no, because due to certain accounting practices, this is a type of security called mark-to-market, which means that it doesn't need to be marked to its current price on the balance sheet. Meaning that the bank could keep on carrying this asset, which is essentially worth less and less and less every time, because as rates go up, that security becomes worth less. As those securities become worth less, they don't have to mark it on their balance sheet. So now they're stuck with a debt to you of $30,000, and the bonds that they've bought with it are only worth $26,000. They now don't have enough to cover that spread. Now here's another thing, is that losses always weigh more heavily on a portfolio than gains do. It's unavoidable. It's like a law of physics. You might be asking, like, how does that even work? Aren't percentages just percentages? Let's say you have an account with $100 in it, and you start day trading, you start investing, you start going all sorts of crazy, and you turn that $100, lo and behold, into $1 grand, $1,000. You've done really well for yourself. Now, what percentage gain have you made on your initial portfolio? So your portfolio, right, started with $100, now it's at $1,000, that's a $900 gain. 900% gain. That is fantastic. But now let's say you were day trading, you didn't know how to invest, you didn't know what you were doing, and you lost that money. Now you're back down to $100, your initial investment. You went from $1,000 to $100. What loss is that? You've lost $900, meaning the same dollar value as your gain, but that loss is only considered 90%, right? Because $900 lost out of 1,000 is 90. Now, that means that a 90% numerical loss knocks out a 900% numerical gain. 1/10 of the numerical value knocks out the entire true value. Now, the reason why this is just so important in accounting is because as these securities are worth less and less and less, so those weigh more heavily on the portfolio than gains ever do. That means that this bank now has to make even more than they lost on the security in order to pay you back. But that's not all. Now, what happens if I come to the bank, you come to the bank, everyone comes to the bank wanting their money? Now, this is a place where banks have taken on insane risk, and maybe they're being compensated for it, maybe they're not, but the risk is insane. Imagine you had a mortgage that you got from the bank, and they said, oh, we can ask you to pay the entire loan at any time. That's essentially what you have with a bank account. Now, the bank, all of their accounts work like this. That means that if you come to the bank and everyone comes to the bank, they can come and draw their money out. The loans that they have made have finally come due, but they're holding these assets, which aren't worth as much as what the account should be paying out. So as these losses get crystallized by constantly selling these bonds, that I've got to sell tons of bonds, I've got to sell $30,000 worth of bonds to make me with $30,000 right. But then that's bleeding into the rest of their stash. What happens when no more bonds are left? This is exactly what's happening with these banks. This is called a bank run. When people come in and they see, oh, everyone's pulling their money, even more people pull their money. That means that the bank is now forced to mark all of these securities, which they had said, hold the dollar value of the accounts. They've now got to get rid of them and add a loss and lock those losses in ways that they can never, ever be recovered from. This is what happened with Silicon Valley Bank in March of 2023, as well as Signature Bank. This is a failure of the fractional reserve banking system, it's a failure of federal stress tests, and it's a failure of the American economy. Are more banks gonna fall? Probably. Thank you for watching.